natural gas is attempting to break below the $3 support level as weather-driven fundamentals remain soft. Forecasts for the next 15 days indicate near-perfect conditions across much of the U.S., with widespread highs ranging from the 60s to 80s, typical of the shoulder season when demand for both heating and cooling tends to be minimal. As a result, national consumption remains subdued. Adding to the bearish outlook, atmospheric G2 projects above normal temperatures for the eastern U.S. through the end of April, signaling limited potential for weather-related support in the near term. Supply-side fundamentals remain relentlessly loose, flooding the market with excess gas and showing no signs of tightening. U.S. dry gas production was reported at 106.8 billion cubic feet per day on Monday, marking a 6.9 billion cubic feet increase compared to the same time last year. In contrast, demand came in notably weaker at just 65.9 billion cubic feet per day, down 7.3% year-over-year. Even with LNG feed gas flows holding steady around 15 billion cubic feet per day, the persistent imbalance between robust supply and lagging demand is exerting downward pressure on prices. As a result, nat gas inventories are expected to climb steadily over the 4-week stretch from April 12 to May 9, pushing levels roughly 108 billion cubic feet above the 5-year average. This shift marks a significant turning point, with the storage balance poised to flip from a minus 78 billion cubic feet deficit to a 30 billion cubic feet surplus, the first time inventories will enter surplus territory relative to the 5-year norm since January. Meanwhile, something more significant seems to be taking shape. President Putin held consecutive meetings with the leaders of Qatar and Oman earlier this week, following the signing of a sweeping strategic partnership agreement with Iran. The deal formalized a deepening alliance between Moscow and Tehran, spanning key sectors such as defense, energy, and infrastructure. While official details remain limited, the pattern is clear, and I'm 99% convinced we'll soon see an increase in oil and gas exports from these key players. Such a coordinated move would only deepen the global supply glut and apply even more downward pressure on natural gas prices over the longer term. The $2.90 support level remains a pivotal line in the sand. While today's test held firm, the lack of weather-driven demand combined with elevated production keeps downward pressure firmly in play. The near-term outlook remains bearish, and if $2.90 breaks, further downside is likely. A bounce from this level could trigger short covering, but without a clear catalyst on the demand side, any rally is expected to be limited. Drop your thoughts below. What catalyst, if any, do you think could save the bulls? Or are we staring down a market with zero hope, where even the slightest rally gets crushed under the weight of relentless supply and fading demand? Please like, subscribe, and comment to support the channel. See you in the next one.